Hey guys, how's it going? Eli here, back with another video where today we're going to be having a conversation about potential contingencies that could cause the overall Pokemon market to crash even harder than it already has in the past 6 months. Without further ado, let's just jump right into it. So as always, letting people know we are doing weekly giveaways. All you have to do to enter is be subscribed to the channel, leave a like and comment on any of the 3 videos we post each and every week, Monday, Wednesday, Friday. We have 3 winners each and every week that we will announce on Mondays, as well as multiple opportunities to enter by just leaving a comment and a like on each of the 3 videos that we post. Basically saying, if you comment and like on each of the videos for the week, you get 3 entries. As we continue to grow as a channel and get closer to 1,000 subs, we will of course begin to increase the amount of product that we'll be giving out to you guys. Now that I've got that out of the way, without further ado, let's just jump right into it. So for today's topic, we're going to be having a conversation on everything that is going on in the overall market outside of just Pokemon, but looking at the stock market, understanding what exactly GDP is and how a lot of these factors are going to potentially play into an economic crash. Of course, these are going to be concepts that we haven't really discussed in depth on the channel. I've talked about it several times, kind of going back to inflation on our video and how that affected an increase in Pokemon booster box prices. But for today's video, it's going to be mainly discussing how this could lead to an absolute crash in demand in regards to retail investment / retail GDP growth. So starting off, we're going to have the conversation about what is GDP growth. For those people that don't know, in short, GDP growth, domestic product, is defined as the total market value of all final goods, services, product within a country in a given period. It includes private and public consumption, private and public investment, and exports less imports. Basically, an understanding of what that means is if I, for example, sell you guys a booster box, you buy a booster box for me, that is GDP growth because it is a transaction that is occurring that is not only helping me yield profit, but then that profit is used to help stimulate the economy, whether it be through me using that to pay off other expenses or whether it be me using it to reinvest in my business. So, of course, as you know, more money is being flowed through the United States economy, this increases GDP stimulation. Increase in GDP stimulation, of course, then allows the overall market to soar, whether it be the overall stock market or whether it just be the overall housing market and so many other markets within the United States, including the Pokemon market, because with that, of course, there's more opportunity being created, more wealth being created, and more product, goods, and services being created, which then in turn allows prices to be a lot more plentiful. So basically, why is this something that's very important? Like I mentioned before, in good times, it allows people to have more opportunity for wealth. More opportunity for wealth means more demand for certain goods and products because people have more money in their pockets, in other words. So this is why GDP growth is very important in regards to the United States economy. Another thing that's very important for a lot of people to understand, and this is where it could potentially get a little confusing, so please, if you don't understand what I'm talking about, there's going to be articles that you can see the kind of links that I'm going to be talking about. Also as well, if you don't kind of understand the first time, you can always come back and watch the video or look up a lot of these concepts to truly understand. One of the biggest things we've had recently for those people that don't follow the stock market is you've seen an absolute crash since the start of the year. The potential reason for this, if you're following the S&P or SPY, and if you're following the overall Dow as well as the NASDAQ, is potentially because of the fact of the matter, or more than likely, if we're being honest here, the fact that the government has announced, or more specifically Federal Powell, Chairman Federal Powell, is saying that they're going to be tightening down on overall interest rates within the market. So basically, when you're talking about interest rates, what exactly are they discussing? So in regards to what are Treasury yield rates, for those people that don't know, are basically a factor in which, here we can read it, and we're going to look at this chart. We're going to be having a conversation about why the Treasury yield rate is a benchmark used to decide overall mortgage rates across the United States. We're going to try and talk about all these points kind of briefly because I don't want to really do it with a lot of these concepts, but basically you're going to just understand what these things are and what they mean and why they correlate to Pokemon. So once again, we're going to be looking at an interactive chart showing a 10-year Treasury yield back as far as 1962. This is a benchmark used, like I said before, to decide the overall mortgage rates across the United States. One thing for you guys to understand why this is important is if you think about it right now, the general American is spending about, a large portion of their savings to go get a home. And what are they doing to be able to buy a home without having to, of course, pay out of pocket? They are going to be getting a mortgage. And what is, of course, come with a mortgage? It comes with interest rates. One of the things that we've kind of seen within the past couple of years is record low interest rates. However, the government, more specifically the Fed chairman, Powell, has announced that he is going to be potentially tightening down, or more than likely in March, tightening down on overall interest rates and potentially causing them to increase. Of course, why are they doing this? The reason why they're doing this is because inflation, as we talked about in our last video, has really started to go out of control. This is something that a lot of investors have really, of course, been fearful of, because as inflation, starts to increase, it decreases the overall value of the dollar. And when it decreases the value of the dollar, then when it comes to actual realized, wages, it goes down. So your value, let's say, for example, a McDonald's worker, they're making about $15 an hour now, versus not that long ago in my state, specifically of Oregon, they're making about $10.75 to $11.25. You might say to yourself, wow, that's a great increase. When you talk about the fact of the matter that across the board, the overall rate of, interest unrealized, or I shouldn't even say interest unrealized to confuse you guys, but inflation unrealized has increased the overall cost of everything across the board, then that actually realized wage increase has gone down, because everything has become more expensive even though wages have gone up. And so you have to understand the difference between the two when looking at the overall inflationary rate. So the reason why, once again, they're going to be raising the potential Treasury rate, which once again correlates to mortgage rates, is because they're trying to tampen down on overall inflation by trying to slow down spending, by trying to make sure that when it comes to the overall value of the dollar, it's going to be increased and not diminished by inflation. That's kind of one of the things when understanding, why this is so important, is because when looking at the overall growth of the economy, one of the biggest, correlating factors in understanding how an economy is doing is looking at the mortgage rates, because that correlates to the overall housing market. So as you can see, I've used the word probably correlation 1,000 times, because a lot of this all ties in one with another, because it's just one big kind of macro understanding of an economy. It has its all little intricacies, and of course Pokemon plays into this, because even though it is not a large market in regards to like the stock market, as well as the sorry, I have to take my breath for a second because I'm talking so much, stock market as well as the housing market, but it still has a market of its own with about $5.5 billion, if I'm correct, when talking about the overall, traded volume of, modern Pokemon prices, which is huge. So as you guys can see, back in 2020, this is kind of what we're going to look at. You can see that the overall year open for average yield prices was at its low of 0.89%. You've started to see a steadily increase, and as we can see in this other article, 10-year Treasury yield hits its 2-year high and hovers around 1.8%. By around 4 p.m. Eastern time, the yield on the benchmark was at its high. Basically, the yield on 30-year Treasury bonds climbed 7.7 point basis to the 2.19%. Meanwhile, basically understanding, once again, things have started to increase. Last week, Federal Chairman Jerome Powell told the U.S. Senate that they expected a series of interest rate hikes this year, along with a pullback in pandemic economic support measures. Once again, basically kind of bringing home the point that they're expecting to increase the overall rate to get a mortgage and borrow money from the government, on top of the fact of the matter that they're also going to be pulling back on overall economic stimulus programs that we've seen kind of like within the past 2 to 3 years, because we spent over $10 trillion, I think, at this point in regards to economic recovery within everything being completely shut down. And of course, because of all this economic spending, it's led to an increase in inflation. Philadelphia Fed President Patrick Harker told CNBC that the bank could raise rates 3 or 4 times, which is another thing that is actually very scary to really think about, because of course this could cause things to go up more in regards to overall rates, which could make getting a home even more expensive. It's not the Fed's interest to see the 10-year spike up to 2% by the end of January, trigger a decline in consumer expectations, a sell-off in equity markets, and trigger a recession, he explains in a phone call. That's kind of, once again, the main point in which we're going to be talking about, which is why I kind of went to the end of the article, because that's one of the big fears in which talking about this, concept today, is because if we do see a potential recession occur, that means less money in people's pockets. And if people have more money in their pockets, that means that's more money to spend on consumer goods. And what is considered to be a consumer good or service? Pokemon products. So that's something that's very scary to really kind of understand and take a look at. Here's a couple other things we're going to be having a look at in regards to the article. Another article, stock market warning signals. Here's what surging bond yields say about the S&P's return in the next 6 months. A sharp rise in U.S. Treasury yields so far this year have further to run, but the speed and scope of the move so far signals the stock market returns in the month ahead could suffer, according to top Wall Street technical analysis. As we've kind of talked about, we've seen a huge overall decrease in the overall value of the stock since the start of the year, upwards of 8%, like I said, for the S&P. We've found the current yield is a percentile of its recent range, along with the pace of rate of change as shown over the recent path, had its biggest impact on the forward returns for the S&P in Wednesday's note. You can see, of course, once again, as the yield impact kind of starts to go, you can see the overall prices of, once again, the yield for the S&P kind of start to decline. The lower the level of rates and the faster the collapse in those rates, the better for the stocks. Once again, lower rates, good economic times, typically speaking, because it stimulates overall GDP growth, it stimulates overall spending, good for overall stocks because that's more money for people to invest. But as they tend to climb, that's going to cause more and more, tightening on overall demand. It's going to cause more and more expenses when buying things, and then of course is going to then cause overall stocks and a lack of investing to occur, which then in turn causes the overall markets to decline. With the 10-year yield having broken above resistance at 1.77, the pace of the advance has pushed Renmark's yield impact model into its highest historical decile, I don't know how to pronounce that, I apologize, and the one pressure forwards equity return historically, he said, is shown in the bottom. The yield, this is once again just kind of, like I said, driving down the point of everything that I've been making. So without kind of going into this a little bit more, just once again, just bringing home some of the ideas and things that we talked about in the other video, in regards to inflation, and then talking about the other articles, just understanding these basic concepts, which is, once again, in regards to the market, or specifically, Federal Chairman Powell saying that they're going to be increasing these rates. It's going to cause a harmful effect on the overall economy because it is going to affect overall consumer good prices in regards to the inflationary rate increasing, and so they're trying to tamper down on that. Will it be good for the market long term? In theory, yes, but in the short term, you're going to see a overall demand decline in regards to consumer goods more than likely, especially considering the fact of the matter that they're going to be increasing the overall yield rate from the Treasury. So this is something, once again, that I think is very important for you guys to understand, because there's been a lot, and here's where we're going to go back and kind of tie everything in within Pokemon prices. There's been a lot of talk recently, and I obviously made a video about this the other day, a lot of talk in regards to have we found a potential bottom for the overall Pokemon sealed market. As you guys can see, Brilliant Star once again has shown within literally 2 days another increase in its overall prices. You've seen other products really start to find their bottom, and I already went into this in depth on Monday's video, so we're not going to do that today. But once again, I'm going to kind of bring home the fact of the matter of why I think that doesn't mean we're out of it yet. Not to mention the fact of the matter, we're also going to look at one more thing. We're going to talk about the Google Trends chart, which I've shown many times for you guys before when taking a look at how we can see an overall demand in Google searches of what people are looking up in regards to Pokemon cards. As you can see, we look at Pokemon cards, we say past 5 years, more specifically the last 3. What do you know? The overall market is still in a decline. You want to talk about the fact of the matter, you say 2004 to present. Once again, absolutely in a decline. Take a look at the past 12 months. It looks flatlined, but in reality, this is just spanning of 12 months and how much it's actually started to decline. what does this basically say? You've seen an overall decline in the market across the board. You've started to see an overall decline in the stock market since the start of the year across the board. You see the Fed trying to increase the overall Treasury rate, which in turn correlates with the overall rate of borrowing from banks to get a mortgage, and then in turn causes less money in people's pockets. It in turn causes the overall stock market to go down, and then in turn causes there to be less and less people wanting to buy consumer goods. Specifically, if they have, let's say, a surplus in the household where they have more money to spend on Pokemon, they have more money to spend on video games, etc., etc. So just really driving home the main points of this video. I'm going to try, like I've done before in some of my other videos, to really just once again keep this on the shorter side, because I don't want to continuously kind of ramble on in regards to the concepts we're going to be discussing, because I want this to be a video in which you understand the main points of what we are talking about. Understand what exactly is at stake in regards to what's been going on. The overall economy has been going well leading up until around 2020. And here's going to be the main point for today's video. If you obviously already saw the video, then hopefully you understand these concepts. But once again, wrapping up, here's the main point for people that are trying to understand and just the general basis of what I'm preaching. The economy from, basically the turnaround time of around 2012 leading into now what is, at the time 2020, you saw huge growth, prosperity of an economic boom. We saw the obvious recession that occurred because of the global pandemic. Then you saw a bunch of money being spent to kind of bail out a lot of people that weren't working. This, of course, caused the overall rate of inflation to increase. We talked about that in one of our other videos. Now the government is coming out and saying they're going to try and control the overall inflationary rate by causing a increase in overall yield treasury bonds, or more specifically just the borrowing rate. With that being said, you're going to see that have a correlating factor into, once again, looking at mortgage rates. Mortgage rates, of course, are going to play a factor on how much it's going to cost for individuals to buy and try and get a home over a 30-year period fixed, and that, of course, is going to cause it to be more expensive as the rates increase. As rates increase, it's going to cause a less of demand, and as we saw as well in another article, as rates increase, it's shown a correlation to the overall rate of stocks and overall indexes dropping. Once again, of course, as you see stock indexes drop, as you see housing prices, more specifically with interest rates, begin to increase, then you start to see overall consumer goods being spent and GDP growth go down. This, of course, is going to lead into overall Pokemon card prices more than likely going down, because once again, you're going to have less and less of a demand, as we've seen over the past couple of years, start to decline. Obviously, when I say the past couple of years, I really mean going back leading to the start of 2021 and now into 2022. We saw the sharp incline from the start of 2020 as we really got that bailout, everyone got the stimulus checks and so on, but now we're going to see a potential tightening of this market, which could lead into, in my opinion, a potential economic disaster. I'm not trying to say this to be like all doomsy and gloomsy, and I'm not saying that, of course, the market all of a sudden tomorrow is going to crash 50%. But what I am saying is that these are a lot of economic policies that are showing very, very hard times in regards to the future of the economy, which in my personal opinion, once again, driving home the main point of what today's video is going to be, in my personal opinion, this is definitely not going to be the bottom for the Pokemon card market, especially if a lot of these things truly play out, which they're going to at this point, because that's what's going to need to happen to, push off, try and get over this, overall inflationary rate and to recover from everything that's been spent to kind of dig ourselves out of the overall pandemic. And so for those people that, once again, driving home last Monday's video, who were, having that discussion about FOMO, there's no need to FOMO. Once again, doubling down on that, saying that everything as far as opportunity is going to be available to you within my personal opinion the next couple of years. Obviously, you'll have its waves when you're looking at everything from a smaller lens of, oh, this month it was up and this month it was down and this month it went up. But if you look at everything from a 3 to 5 year lens, if the Pokemon box price goes from $100 to $120 in the scale of 3 to 5 years, that's going to look like nothing if the booster box prices 5 years from now goes to $300 to $400. So everything is looked at for most people from a short-term scale. So you have to really look at the bigger picture in regards to this and why this is going to be a great opportunity in regards to invest, and why you shouldn't also FOMO within, you know, these current short-term price products. Obviously, as I've said before in other videos, dollar cost averaging is something that is, of course, you know, a good general strategy. Once again, not financial advice, not a financial advisor. That's not what I'm suggesting, but I'm just saying from a general strategy in investing, a lot of people do that. So please, of course, you know, be very wary of where, you know, you're putting your money. That is a decision that you're making for yourself. I'm just a guy who understands macro and microeconomic theory really well, and is just trying to share a lot of my personal information, as well as understanding what is going on for those people that are trying to get a hold of Pokemon product to invest in long term. Hopefully, once again, these are ideas that are you guys were able to understand. If you have questions, I will make sure, of course, to try and respond to them as quickly as possible in regards to this topic, because I know this is going to, once again, be a very, very complex topic. If you guys are interested in kind of trying to look at these articles yourself and trying to understand, really just take a look and see if you don't understand what GDP growth is, doing a little bit of research, and then kind of looking and doing research on what's going on in the stock market, as well as understanding what's going on with the Federal Reserve, and trying to see why they're doing all these things. If you didn't understand, of course, what this video is, hopefully this was of service to you. But if not, you can always do your own research, because I just want you guys to at least know about this stuff, because it is going to play a factor not only in how much everyone's going to be making across the board, as well as how much prices are going to cost in regards to purchasing, you know, goods, services, rent, bills, expenses, and other things, but also it's going to cause an effect on the overall investment opportunity, in my personal opinion, for the good thing, as a good thing if demand goes down in the near future, in my personal opinion, for the next year or so. But with that being said, as far as it goes, as always, please make sure to leave a like, comment down below on this video, and be subscribed to the channel if you want to enter yourself into our weekly giveaways. We announce our winners on Monday, and all you have to do to enter is, like I said, like, subscribe, and comment on the videos. You have an opportunity to enter 3 times, because we post our videos Monday, Wednesday, Friday, and then we also have 3 winners on top of that, which allows you to have multiple opportunities to enter, as well as multiple opportunities to win. Now, as far as it goes, that is all I have for today's video. Once again, if you have any questions, please feel free to leave them down in the comment section below. I'd love to have conversations with you, why you think I'm right, why you think I'm wrong, so on and so forth. And if, once again, you had a lot of questions in regards to, I have no idea what the hell he's talking about, then please feel free to ask, because I really want people to understand these concepts. But that is all I have for today's video. Until then, I will talk to you guys on Friday, where we're going to be having a conversation about some Pokemon product that has actually started to shore up that might be very interesting to see. Will it cause the prices of a lot of older product to drop? But until then, I will see you guys on Friday. Peace.